Welcome to RAIN, the Real Estate Investor Growth Network with your hostess, Jen Josie. Join like-minded real estate investors and accelerate your business towards greatness. You will hear step-by-step strategies for success, interviews with real estate rock stars, and we will dig deep into past projects where we bear it all, including the good, the bad, and some just plain ugly. So get excited. Here's the bestower of badassery herself, the real Jen Josie. Listener discretion is advised.
Hi, and welcome back. I'm Jen Josie, creator of RAIN, the Real Estate Investor Growth Network. Whoop, whoop. On today's episode, we have a guest that will be sharing their badassery. But before we begin, here's today's badassery bestowment, a little badass gift to you. Today's topic is branding. In the competitive landscape of real estate investing, establishing a strong brand can set you apart and attract both clients and opportunities. Here are 7 key points on why branding is crucial. Number 1, differentiation. Branding helps you differentiate yourself from competitors in a crowded market, identifying what makes your approach unique and highlight it in your branding. Number 2, trust and credibility. A well-crafted brand builds trust and credibility with clients and partners. Consistent branding across all platforms conveys professionalism and reliability. Number 3, memorability. A memorable brand sticks in people's mind. Create a brand identity that resonates with your target audience and leaves a lasting impression. Number 4, value perception. Strong branding can command higher perceived value for your properties or services. By associating your brand with quality and expertise, you can justify premium pricing. Number 5, customer loyalty. Investing in branding fosters customer loyalty and repeat business. Build a positive reputation that encourages clients to choose you for future transactions and refer others to your services. Number 6, marketing efficiency. A cohesive brand strategy streamlines marketing efforts. Consistent branding across digital and traditional channels maximizes your visibility and reinforces your messaging. Number 7, adaptability and expansion. A flexible brand allows for future growth and diversification. If your real estate portfolio evolves, your brand should adapt to reflect new offerings and target markets. So remember, effective branding goes beyond just a logo or a slogan. It encompasses your company's values, mission, and overall reputation. Invest time and resources into developing a badass brand strategy that aligns with your business objectives and resonates with your audience. Now on to today's episode of the Real Estate Investor Growth Network podcast. We have with us Jeff Ball. Jeff serves as the CEO of Visio Lending, the nation's leading lender for DSCR loans. He is responsible for setting Visio's overall strategy and direction. In 2016, Visio made history on Wall Street, completing the first ever investor-only single-asset DSCR mortgage securitization. Since then, the company has completed 11 S&P rated securitizations totaling nearly $3 billion in DSCR loans. It is my honor to have a celebrity on today's show, so welcome Jeff Ball. Thanks for being
Jen,
here.
it's good to be with you. Yeah, thank you for having me.
Did you hear that applause?
I know. It's like I feel like a rock star.
You are a rock star. I am so thrilled to have you on here, and I had to give a little disclosure when we started. I, in my business, am the mouth, the marketing, all that fun stuff. My husband does all the financing side of the business. So when you say DSCR, I'm like, okay, yes, I know exactly what that is. So I do know there's huge benefits in this type of loan. And so let's get to basics here. So Jeff, how did you get involved in this industry? Let's start there.
Yeah, so we started a business back in 2006 that was called Econohomes, that during most of the financial crisis was buying and selling single family investment properties around the country. Most of the team came from the financial services backgrounds. We were kind of capital markets, Wall Street types. And so what we had were relationships that enabled us to buy foreclosed properties directly from financial institutions. And really the insight that we had is we turned around and built a much more efficient distribution channel to resell those to small local investors. Most of these were inexpensive properties. And so realtors at the time really weren't interested in selling them, and there wasn't a lot of financing available. And so we were able to kind of build this network of small investors located around the country who were interested in buying properties, and then they would renovate them and rent them. And what came out of that was really the idea to start a financing business off of the side of it. And so initially we started off financing just the properties that we were reselling. So Visio was really a captive financing arm of the properties that we were reselling. But then, we could see that there was a real gap in the market. And at the time back, so this was early 2010s type timeframe. The hard money fix and flip financing market was really highly, localized. Most of the money for flipping properties came from, country club money and local small hard money lenders. There really weren't many national hard money lenders at that time. A couple started to get set up. And so we were looking at that opportunity because we had financial kind of wherewithal and an investor database. But we were also very interested in how could we provide more permanent finance for rental properties, because we could kind of see on the horizon we thought that was going to be a really interesting opportunity. We weren't the only ones because Wall Street was out there buying rental properties. But we were interested in the financing side of it rather than buying the physical properties. And so we moved Visio into financing, providing third-party financing for other investors. And kind of one thing led to another, and the big break was in kind of the 2015 timeframe. We were looking at how might we be able to provide long-term, 30-year term financing for rental properties, and we got synced up with the right capital partner that really had the Wall Street kind of bond market expertise to pull that off, and kind of the rest is history. So really since late 2015, we've been focused on just doing one thing, which is financing single-family rental properties, both today long-term, short-term, and increasingly mid-term rental properties.
And I love that most about you, because when you started a couple years prior to you getting into this business, this company called Airbnb was created. And a lot of people were making money, lots of money quickly and in this industry. And I can remember Visio for the longest time was the only lender that would finance short-term rentals, which is huge because there's so many out there. And honestly, I did not find you in time. I had to do a a portfolio loan, throw some long-term rentals in there. So you had the history. And so anyway, I chose specifically branding because I feel you all are out there, but I just wanted to make sure my listeners heard firsthand what badasses you all are and what you did. So one of the greatest things that your company has done is you were the pioneer for this DSCR loan. It was you and maybe another one or two in the industry, but really, truly, you all were the pioneers behind it, and you originated the DSCR loan, which we are going to break it down. We're going to dumb it down for Jen, the marketing person, and go into the trenches here on the financing side of things. And first of all, what is a DSCR loan and what does DSCR stand for?
Yeah. So let me give a little bit of context, because I think you were just talking about some of the alternatives which you faced when you went to finance your STR property. So, prior to kind of the emergence of a DSCR loan, investors who wanted to own single-family rental properties really had two choices. The first choice was to finance it with an agency loan, which is kind of a loan, a Fannie, Freddie loan. And those loans, the attractiveness of them, they do have a 30-year term on them. And often the rates and fees are attractive, or at least in the past they were. The challenge with those is you actually have to qualify based on your personal income. So you're going to have to qualify based on your debt to income ratio. You're going to need a W-2. You're going to need your tax returns. And a couple of other more nuanced issues is the way they...
Let me pause you there for a second, because listeners, when you get into this industry and you decide I'm going to go into real estate investing full time, you a lot of times can't qualify for these loans anymore because of your W-2, because you are a business owner, et cetera. So I just want to clarify that, why this is so genius and why you're such a celebrity in my book. So keep going, Jeff.
Yeah, no, great point, Jen. That's right. Part-time and full-time investors often don't have a W-2, and or their tax returns can be pretty complicated. There's some interesting things you can do as a real estate investor that really improve tax efficiency, but it can work against you when you try to go obtain kind of more traditional financing. So investors could go get an agency loan, was one structure, but you really had to be able to qualify just as though you were buying it to live in it. The second alternative was, if you had the financial wherewithal, you could work with a local bank, and local banks have more flexibility about how they underwrite the loan. But the negatives there are a couple-fold. One, the terms, even though they might have a 30-year amortization, meaning the repayment period is calculated over 30 years, the actual term on those loans is typically 5 or 7, maybe 10 years. They have what's called a balloon payment in them. And so as an investor, that's actually not permanent finance, because you face the risk that you would have to refinance that after 5 or 7 or 10 years. So it takes away from the peace of mind, I think, for a lot of folks. And the second thing, and this is actually very much the case today, local banks kind of come and go with respect to their appetite for financing, real estate based on a whole bunch of regulatory considerations. And so as a real estate investor, if you're trying to build your portfolio, what you really want is a capital partner that you know is going to be there as you find deals, and that you're not constantly having to gauge whether your capital partner can fund you. So that's kind of the environment that DSCR came into the market. And so, DSCR loans offer a whole bunch of advantages. We can kind of click through them. I don't know whether you want to start with advantages or you want me to start with the mechanics of it, but let me tell you what it is.
What does it stand for?
Yeah. So debt service coverage ratio, it's kind of a mouthful. It's kind of, and it's borrowed really from the commercial real estate world. So debt service coverage ratio, at the high level, what we are looking at is, will the income from the property, the rent, will that cover kind of the fixed payments associated with the property? And when I say fixed payments, we're talking about related to the loan, the principal and interest component of the loan. So it's referred to as the P&I, then the annual property taxes, the annual insurance costs, and then if it has any sort of association dues, right? So what you'll hear is the DSCR typically is calculated as the monthly rent is the numerator in a fraction divided by the PITIA. And so that typically needs to be a good DSCR is 1.2 or greater. But depending on the markets, DSCRs down to 1 are considered very good credit. And we and other lenders will go below 1, but there has to be some compensating factors associated with that. So to explain what that means, if you have a DSCR below 1, it means that the monthly rent that you're receiving isn't enough to pay the monthly principal, interest, taxes, insurance, and association dues, right? So as a lender, we have to get comfortable that there's another way in which you're going to be able to make up that gap.
Okay, so let's dumb it down for Jen. Let's use some real world numbers here. So I am looking at buying just a single family home, long-term rental. We got a lease on there. My PITIA, always forget about the A on there. So thank you for it. Is going to run me, let's say, $2,000 a month. Okay. Right. So to make this pretty, Isn't that the right term to make it pretty?
Actually, and just keep it real simple. Say it's 1,000.
Okay, 1,000.
It keeps it easier, folks. My rent's going to need to be $1,200.
$1,200. Thank you. That makes it even better for me. I like those numbers. And then, so I'm pulling those numbers, and then so the top number is just what's coming in, and the bottom number is what's going out. Okay, got it.
Yeah.
So here's a real world situation for you. We were looking to refinance, and I already told you my credit score is in the dumps right now, but we're looking to refinance. We have two properties. One's a long-term rental, and then one's a short-term rental. And we had to do exactly what you said. We went to a small local bank, because this was back in 2017 when we did that. No, 2018. 2019. And so I had not discovered you yet. So we had and it took forever to refinance it, because it was like putting a square peg into a circle. And it was just because it was a small local bank, they really, busted their rear ends trying to make this work for us. But our little tiny cabin in the mountains, that is a short-term rental, has a DSCR of 2.8, by the way.
Yeah.
And then our long-term rental is 1.2. But our credit is crummy right now, so we can't necessarily refinance that right now. But in a situation like that, they had to put it all together. And another factor is the tiny cabin is under 750 square feet. And a lot of banks don't like to finance anything either under 750 or sometimes 700 square feet. It's 486 square feet, but it's a 2.8. So I know we're sitting on gold here, and that's why I was so excited to have you on the show, because that makes total sense. Why wouldn't a bank jump all over that for what's being brought in? And then you had to come around and create this for us. So first of all, thank you for that. But I went off on a tangent there. So we talked about the alternatives, but what are some current terms and trends that you are seeing with this loan now?
Yeah. So one thing is folks think about DSCR loans. So in order to have a 30-year term, the product really needs to be able to be refinanced in the bond market, right? And so, when you think about,
what does that mean?
Bond market? It's the bond market. Yeah. Essentially the way we refinance our loans is we gather a pool of loans together that we've originated to you and a bunch of other investors. And then we take those loans and we go to Wall Street. And what happens is to keep it really simple, we sell the equivalent of like loan products to bond investors. Bond investors they lend us money against the collateral is all of these loans that we've originated. And so it's a very efficient way to be able to get large amounts of capital for long periods of time. And so today, what drives interest rates in the DSCR space is actually pretty similar to what drives rates in the consumer mortgage space. So today, when I looked at this morning, the 30-year consumer mortgage rate is about 7.5%. And I would tell you on DSCR loans, the average rate right now is in the 8.10 to 8.15 range, 8.1 to 8.15% range. And that would be, for somebody who's probably in the 740 to 750 type of FICO range, with a DSCR of 1.2 thereabouts. I think, and interest rates have been bopping around just as they have been in the consumer mortgage space. They had, they had actually gone down pretty materially at the end of last year, and now they've trickled back up. And that's largely, again, driven by the fact that I think increasingly people feel like our Federal Reserve is probably not going to reduce interest rates as much as we maybe thought they were going to, at least in 2024. And while that doesn't directly drive mortgage rates, it indirectly drives mortgage rates. And so that's, I would say rates are, folks should be thinking that DSCR rates are kind of in the low 8s right now.
And to me, that doesn't matter because I'm not paying that interest rate. My renters are paying that interest rate for me. Just FYI, listeners. So don't go, stop clutching your pearls. Right. That is a great interest rate right there. So love it. All right. So why Visio over these? Because I mean, again, you guys are the pioneers, celebrities, but now more and more companies are coming out with a similar type product. So why Visio over all these other companies?
Yeah, so at this point, we've been originating this loan for about 8 years. We've done more than 10,000 of them and about $3 billion in originations.
Billion?
One of the things that, $1 billion. I think something that's unusual about us is we do one thing. This is the only thing we do, which is finance single-family rental properties. So most financing companies have a variety of financing products, and there's good business reasons to do it that way. For us, we just believe that the role that we can play in the market, is significant. The need for housing in the country, we all know that there's a housing shortage. And there's going to be a variety of ways that housing shortage needs to be addressed. There's a role for folks who are flipping properties because there's a lot of aging housing stock in the country, and there's folks that finance those. That's incredibly important because first-time home buyers don't want to buy fixer-uppers, and in most cases, maybe first-time investors do, but folks who are living in it. But what we do is we provide the long-term financing for investors that want to build wealth over time owning rental properties, and we just think that's a huge market opportunity. So we've chosen to optimize our entire organization around doing one thing. So my pitch to folks as to why they would work with Visio is couplefold. First, and not to use too much business jargon, but we are vertically integrated, meaning we are the lender. We do everything from originate the loan, so this is who you would be working with, to we are actually known on Wall Street as the folks that make these loans. And the advantage of that is, we've got certainty of capital, and that means for investors, we know exactly where we can finance properties, and we're well capitalized to always close. We've never not closed on somebody, and so certainty is certainly valuable. And then also because the entire process is optimized around this, we've seen almost everything you could see in this space, so we know where the speed bumps are or the things that will get you tripped up. And what that means is we try to be as forthright and transparent throughout the transaction, but particularly towards the front end of the transaction. We don't want to start a loan if the loan's not going to get completed, just as an investor doesn't want to start the loan if the loan's not going to get completed. So, I think that's just really the experience, that we have. We aspire to offer a great product with an outstanding customer experience. And we have lots and lots of repeat business. Every month, half of our business comes from repeat customers.
Nice.
And so we love that. And it's fun to watch the success of our investors grow.
So how this fits in, and I'm going to break it down for the audience. If I am doing, say, a BRRRR strategy, and I find a really cute little cabin on a lake, and it needs a lot of work, so I'm going to finance that as I regularly would with a hard money loan, maybe a private money loan, fix it up. But what a lot of people don't set their eyes on is the ending, and they're focused on flipping it. What can they make for it? All this stuff. How soon do you come into play in a situation like that? Is there a seasoning period to have renters in there? How does it work, your piece? Because I do love that you focus on one thing, because there are companies that do all this other, and again, putting that round peg in a square hole, or square peg in a round hole, whatever it is, and just trying to make it work. So I do love that you focus on one. So anyway, take it away.
Yeah. So in a BRRRR, the last two R's are refinance and repeat. And so we come into that situation with the refinance. So with a BRRRR, somebody's bought a property, they've renovated it. And let's assume rather than flipping it in terms of selling it to another investor or selling it to a homeowner, their decision is that they actually want to hold it in their portfolio as a rental property. And so that's where we would come in, where they currently have a hard money loan. They've finished the renovations and the property is completed. That's the time when they would bring it to us. They don't have to have a tenant in place, but the property needs to be completed. And so this, we can drop little nuggets of wisdom in here. This is one place where investors often get tripped up. They try to start the refinance too soon. The property isn't fully completed. We order the appraisal on the property. The appraiser shows up. We get the pictures back. And it's like, the property's close to being completed, but it's not done, in which case the property is not ready to be refinanced. And so then you kind of go through a little bit of, starts and stops with, them trying to finish up the property, get new pictures, those sorts of things. But that's we don't have a seasoning period per se. Most investors, though, will look at if the property's been owned less than 6 months. Most lenders like ourselves are going to look at that, and we're going to ask ourselves, what did you pay for the property? How much did you put into the property to improve the property? And we're going to be comparing that to what's the current value of the property. And there's certainly ability to get not only the cash that you put into the property, but some additional cash out. But most investors or most lenders such as ourselves are going to be very cautious about how much cash above and beyond your cost basis that they'll let you take out of the property. And since you brought up Burr, the other little nugget I would share with folks, this is a gotcha. It's not uncommon working with hard money lenders that hard money lenders are actually pretty flexible or can be flexible about repayment terms. You're often only making interest-only payments. You pay the principal at the end of the loan. Most hard money lenders and fix and flip lenders, they may offer you the ability to renew it for an additional fee or those sorts of things. One of the things in the DSCR space, DSCR lenders are not nearly as lenient with respect to payment performance. So you don't want to be late on making your payments on your fix and flip or hard money loan and then try and take that property to somebody like us and refinance it, because we will see those late payments when we get your payoff request. We will see any sort of late fees and things on there, and it draws into question the likelihood that you're going to make timely payments on your DSCR loan. So my encouragement would be, just for those who are using hard money, private money, fix and flip money, to just make timely payments on that, and realize that payment performance is incredibly important on DSCR loans. For the most part, if somebody goes 30 days late on a DSCR loan, their lender probably is going to be reluctant to lend to them again.
Right. Wow. Well, that is a great nugget. And so my next question is, what do you typically finance? Do you do 85%, 75%?
Yeah. So in the DSCR space, typically you'll see 80% on purchase, and you'll see 80% on a rate and term refinance. So a refinance where you're not getting out anything other than just nominal additional cash. And then you'll typically see about 75% on a cash out refi. And you'll see some variations on that as you move up in loan size. Sometimes the maximum loan to value comes down by 5 basis points, something like that. But you should be thinking of, on purchases, you could get as much as 80%, and on rate and term, 80%. So in your Burr strategy, and then 75% on your cash out refi.
And then is there a limit on how many you can roll into one loan?
So great question. And so you'll hear about folks talk about portfolio loans in the DSCR space. And so we currently do not offer a portfolio loan, but there are lenders out there that do that. And for the most part, those portfolio loans are usually 10 properties or less. There's some technical reasons that are practical reasons, really, as to why folks tend to limit them to smaller number of units. But so there are portfolio loans out there, and those offer some attractive features, right? If I owned 10 investment properties, I would love to have one loan payment and one insurance policy and those sorts of things. So there's attractive aspects of it. There are also some drawbacks to portfolio loans, because there's usually limitations, or if you go to sell one of the properties, you may actually have to kind of contribute additional equity into the loan. So there are some drawbacks, but yes, there are portfolio options out there.
Okay. And to kind of wrap up this first part of the podcast here, we talked about the advantages of using a DSCR loan, and can can you go into a little bit more? I know we talked about that you don't have to have a W-2, that you can also purchase it with an entity. Are there any other advantages? Because to me, it's a no-brainer to go DSCR now, but anything else on there?
So, I think, so the advantages I would highlight, you mentioned a couple of them. First, you get underwritten based on the property level cash flow rather than your personal debt to income.
But
you mentioned the second one.
You still need to see credit scores, FICO,
Correct.
Okay. Anything else from your personal? Yeah.
So you need, we underwrite to credit and depth of credit. So we're going to look at your credit score. We're going to look at how many trade lines you have, how long they've been open, any mortgage experience you have. On the negative side, we would also be looking at any sort of disqualifying event if you had a foreclosure or a bankruptcy within a certain period of time. On the borrower, we're also, we run background checks. So we use background checks rules, search engines. And so, for us, it's very important for us to know up front if there's criminal convictions either in the past or pending, we want to know about those. Not all of them are disqualifying, but it's just, we will find them in the process of doing our diligence. So those are kind of the key things that we're looking at. And then at the property level, we're going to get an appraisal. And there's also a secondary valuation tool that's used to validate the appraisal. And we're going to review the appraisal and decide whether we think the appraiser did a good job or not. And as part of that appraisal, we're going to the appraiser can actually provide what's called a 1007, which is a rent schedule. So they can give us an estimate of market rent. Oh. And so we're going to look at what the appraiser thinks the rent is. If it's a refinance and the property is already rented, we're also going to take into account what's the existing rent. And typically, at Visio, we typically use the lower of those two, either the in-place or the market rent. And I'm talking about for a long-term rental. There's some nuances on short-term rentals. But getting back to the advantages, I think you alluded to one of them. The fact that you can finance in a corporate entity is a huge advantage for investors. That is not available if you use an agency loan. You can do that if you're using a bank loan. But the advantages for folks, without going into the weeds, is just it really does provide some protection or segregation of your assets so that you can put your investment properties in a legal entity and you can shield your other assets potentially from any sort of liability. So if something bad happens with that on your property, as the owner of that property, you could face some risk and liability that you should be insured for. But and then the other advantages of DSCR loans, I would say a couple of things. So first, with the agency loans, you're going to have volume limitations. You can typically only finance up to 10 properties there before you get capped out. And that's assuming you actually have the income wherewithal to get all the way to 10 properties. The other thing is the way those loans are underwritten, there's a cash reserve requirement that's cumulative. And so as you go to finance your next property, they're not only going to ask, do you have sufficient cash reserves to make payments on the loan you're financing? They're actually going to accumulate all of that with the other properties that you own. And so for a lot of folks, having that level of cash reserves actually becomes problematic. And so with a DSCR loan, typically the reserves are just calculated on the property or properties that you're financing at that time. So just much more flexible. And in the past, Jen, I would have told you there was probably, a 2 or 2.5% rate differential between that agency loan. That Fannie Freddie loan was less expensive than the DSCR loan. Today, the rates are almost right on top of each other. So there's just not a real cost advantage of getting an agency loan, and they're just more complicated and more cumbersome.
Well, I am truly grateful to you for creating this type of loan, which puts the investor first in mind on how to, make this work in a business where you aren't bringing in a W-2. So you really went, full force with focusing on that investor. And I am truly grateful for that. You heard me at the beginning give a badassery bestowment. Do you have a little bit of advice or a nugget that you can share with the audience members?
I would say my advice with respect to real estate investing, we work with folks again who are flipping properties and who are also building rental portfolios. They're two very different strategies, even though they're related. So to me, flipping properties is about generating current income. It's about often replacing your job, right? So you're looking to buy a property, sell a property, make a profit, and to both fund your business, but also just fund your personal lifestyle. Owning rental properties is very much about building up your balance sheet, building up your net worth. Over time, yes, they can generate free cash flow that you can live off of, but most people build wealth over time with rental properties. You talked about the fact that it's your renter who's paying you, that You're using that cash to pay your mortgage, right? So your mortgage is getting paid down month by month just as time clicks by. Obviously, there's inflation. There's been above average inflation, but properties tend to be a good inflation hedge. So they tend to appreciate over time. Both if you're in a good market, they can appreciate because of kind of increased demand, but just from inflationary pressure, they tend to move up. And so, I think that the advice I would give folks who want to build wealth over time with rental properties is just be prepared that it takes time and give yourself sufficient margin for error. What you don't want to do is over-optimize everything. What you're really doing is you're working towards a long-term goal of building wealth for you and maybe generational wealth. That's what's so fun to watch is so many of the investors we talk to, they're like, yeah, I'm never selling my properties. My kids are going to inherit them and their grandkids are going to inherit them. So that's just, I think it's building wealth slowly, which sometimes isn't super sexy, but it works.
Not sexy, no. But yes, I think that's an excellent badassery bestowment. So thank you, Jeff, for sharing that. We are moving into the second part of the podcast here, which is what makes Jeff Ball a badass, which you truly are. And I use the acronym BADASS, and the first letter is B for book. What's a book that's made a huge difference in your life?
Yeah, I think, the one I wanted to share with you all was I Love the Grapes of Wrath.
I love that you put this on here because so many people do, it actually it's about capitalism, but I love that you put that in there because John Steinbeck, awesome. Sorry, I cut you off. I guess so excited, but why did that book make a difference in your life?
Yeah. So for me, when we started Visio and Econohomes before that, I was really interested in this idea of how do you take a for-profit business model and apply it in a space that has a social impact. And so I was interested in how to address housing affordability. And so for me, Visio plays a really important role in that. I'm a capitalist through and through, but I believe in the power of capitalism and markets. But I think Grapes of Wrath just provides a really poignant kind of story of how capitalism both creates and destroys. And so, for us, we finance in a lot of markets that, saw their heyday 60, 70, 80, 100 years ago around the country. And you just see how local economies, they grow and then sometimes they shrink and they reinvent themselves. And so for me, it's a great look at both the power as well as the some of the darker sides that come along with the destruction that capitalism causes.
And to think you reinvented how investors finance their rental properties. So look at you. I'm impressed. All right. Very well said. All right. The first A in badass is for advice. You gave us some great advice in your badassery bestowment, but what's the best piece of advice you've ever received?
Yeah. So on a personal front, for me, I have, and it actually relates to what I talked about from an investing perspective. I try to live my life with sufficient margin in it. I heard a guy speak one time. He said, life happens in the margin. And initially I was kind of struck because, I was very much driving my life towards a highly optimized, making sure I was making the most out of every aspect of my life, that every moment of my life was filled with something, driving me towards some sort of endpoint. And I think his point was that so much of life actually happens in the space in between. And so, over the years, I've taken that and I've really built that into many aspects of my life. And the advantage for me is living a life with kind of a greater sense of kind of peace, in terms of that my ability to both withstand the often the unexpected. Lots of unexpected things happen, in our own lives, as well as, I'm married. I've got 2 daughters. I've got other family and friends. So things happen in their lives. And my goal by having margin in my life is to be available to help and assist them. So that's, for me, the idea of living with sufficient space in your life, I think, is incredibly powerful. And related to that is the idea, I grew up, everybody said you need to live a balanced life. And that always was so frustrating to me, because it was this sense of like additional pressure, like, oh my gosh, I'm out of balance. And I was exposed to the idea that life maybe isn't about balance so much as it might be about rhythm or seasonality, that there are seasons for things. And so, there can be a season where you're in the real estate business. Hey, I don't have the capital to build a rental portfolio. So I'm focused on flipping properties because it's generating income, and I'm saving some portion of that so that I can actually start my rental portfolio. That's great, right? That's a season, and you're planning ahead towards the next season. And so, I think it's just when we try to do all things at the same time in balance is maybe just an unrealistic expectation for ourselves.
I did not think I could like you anymore, Mr. Ball.
Yeah.
That was a great answer. Life happens in the margins. That is fantastic. All right. The D in badass is for drive. What drives Jeff to be successful?
Yeah. So you and I were joking about our ages. I think for me, as I'm at this stage in my life, so much of probably the thing I'm the most grateful for is, between the 2 companies that we've started, we've had success and we've employed hundreds of people. And it was interesting, Visio is headquartered in Austin, Texas. Austin is not a hotbed of mortgage talent. Most of the mortgage, folks in Texas are in Dallas. There's lots of mortgage businesses in Texas, but they're in Dallas, Houston, or San Antonio, not in Austin. Austin, it's filled with musicians, movie makers, and math technologists. So, we now, probably almost a decade ago, moved to a strategy of hiring a lot of folks who, were typically recent either high school or college graduates, and training them up from within. And so, for me, kind of my greatest sense of fulfillment is just watching people find something that they enjoy and flourish and grow in their confidence of their skills and experience. And so, Visio is just filled with folks that have grown up in the organization and now, are kind of also training up the next generation of leaders. So that's kind of where I get my greatest sense of, satisfaction.
I love it. All right. The second A in badass is for aspiration. I'm a big goal setter. So what is a goal you are currently working on?
Yeah, I think related to what I just described, for me, raising up next generation of leaders is something really powerful. So that's something I've been working on for a while, both in my professional life and also in my personal life. So, for me, I've had just really good fortune in my career. I've worked with some really smart and capable people and been able to learn a tremendous amount from them over the years. And so, for me, I aspire to be able to share that with other folks, and in those places where I can help them. Not necessarily avoid mistakes that I made, but maybe just help them uncover, their own path more quickly. That's something I would love to be able to do.
Very, very cool. All right. The first S in badass is for systems. I'm sure you're a systems guy. So what systems do you have in place to help you achieve success?
Yeah. So for me, I love this image of life as like a garden. So I use a life statement, and my life statement for me kind of defines the 4 corners of my garden. And so I like to, think about how do I go through my day and filter things against that life statement so that I can pretty quickly focus in on the things that are the most important and do those things relative to my life statement. I think like all of us, we're constantly being bombarded with, requests to do things or to help people or to engage in different issues. And so for me, in order to keep that manageable, I use this life statement that I filter things against, and I can pretty quickly, look at it, and I can break things into yes, no, and I try to keep maybes to a very limited basis, because maybes are things that just kind of hang out there. And so I break them into yes, not now, and not ever, so that a not now can be a maybe, but it's a not right now. And so I use those things to try and keep my garden from getting overgrown. And then, I think the other tool, and it's an image that I use, is just a weeding of that garden. Things have a way of coming into our lives. Sometimes you just don't even realize something's come into your life, and it's taking you away from spending time on the things that really matter the most to you. The things that, when you look back on your life, are going to be the most important to you. So for me, it's really important periodically to look at that and go through and weed that garden. So I pull things out of that garden. And what I've found over the years as I've been doing it now, weeds don't come up quite as often, but they still come up. And so, having that periodic process of just going through your life, whether it's on some people do it on a monthly basis. I tend to do it on a quarterly basis, and just kind of say, hey, where am I spending my time and my resources? And are those the places that make the most, that are going to be the most important to me as I look back on my life?
I love that you used, pulling weeds and that analogy, because so many people, when I say systems, are like, I use Google spreadsheets, I use this and that, I use my Google Calendar, Asana, whatever it is. And I didn't think I could like you anymore. And you are a finance person. Well, I did marry a finance person, but
that's right.
We don't even speak the same language. And man, I love that you said that. So I'm going to have to pull some weeds in I'm going to have to do it daily for a couple days until I could get it up to monthly, and then I'll be quarterly. So I love that you said that. All right, Jeff, this has been so much fun. To wrap this up, the final S in badass is success. What does success mean to Jeff?
Yeah. So for me, success is, and it's funny, I say it, and on one hand, I'm like, that's you could take it the wrong way. For me, success is succeeding through other people. So for me, probably my gifting really is much more around being able to identify people's capabilities and talents and helping them get into the right situations. So there was a time when I was probably a much more effective individual contributor earlier in my career. But for me, success today is really being able to identify those places where somebody's either being underutilized or they're in a role where it's not the right fit for them. And being able to identify that and help get them, to the right place. So that's success for me at this point.
And keeping the weeds out of the garden. So
there you go.
This has been so much fun. How do the listeners find Visio, and what is the process for them? They are now chomping at the bit. They have a short-term rental, a mid-term rental, a long-term rental that they are looking to refinance. What does the process look like for them? What do they do?
Yeah, so obviously you can find us online at visiolending.com. You can find out about a bunch of information about us. We have a bunch of great content on there that can just help you as you continue your journey in educating yourself about real estate investing. We have a dedicated team of loan originators who are waiting to assist you. They're experts in this. They've done many, many, many of these loans, so they can guide you through how the process works and again, what some of the nuances and potential pitfalls are. I would just encourage you sooner rather than later, reach out and talk to one of them because they're happy to spend time. We do work with a lot of kind of first time and emerging investors who are just getting started. And so they're more than happy to spend time with you explaining how the loan products work. And they have wonderful stories in and of themselves. Some of them are real estate investors and or they've worked more broadly in the mortgage industry. So they too can spend time with you talking about how to use this financing so that you can achieve your investing goals.
And I think that's excellent advice to call sooner than later, because if you are in the middle of a project and at some point you're going to need to refinance, the whole seasoning period I love that you don't even really require a seasoning period. So that is huge. As soon as you finish the project, and like you said, a little gotcha, make sure it's complete before you actually get that appraisal. But Jeff, this has been fantastic. And again, listeners, it's visiolending.com. That's VISIO lending.com. And they are top cream of the crop as far as loan originators. And so I am truly honored again to have you on the show. So Jeff, thank you so much for being here today.
Jen, thanks for having me. This has been a lot of fun.
Absolutely. And that is all. Thank you for listening, and we will catch you on the next episode. Now go out there and share your badassery. And don't forget, make it a great day. Take care. Bye-bye. Whoop, whoop.
Thank you for listening to RAIN, the Real Estate Investor Growth Network. Be sure to subscribe on your favorite podcasting platform so you never miss an episode. If you need more badassery, you can follow Jen Josie by visiting therealjenjosie.com or become a member of RAIN by registering on rainmastermind.com.